Starting the broadcast. Hi, everyone. Thanks for joining us. Tonight's episode is going to be on Greeks and how to use them. And there's Dmitry. Dmitry, you see me?
Hey, everyone. Yep. I see you, hear you. Good.
All right. Before we get started, let me bring something up. We're going to go through the disclaimer. There you go. So everyone sees it. Market Chameleon is not a registered investment advisor or broker dealer. So take everything we say with a grain of salt. We are not making recommendations. If you have any questions, consult a registered broker or broker dealer. Deem, anything to add to that?
No, that's it. We're just sharing ideas.
Yep, we're
I think
showing
that's
you how
we same disclaimer every week.
We do. So just a couple facts about this. We are using Zoom, so we have a chat section. So put your you can ask anything in the chat right now. I'm going to say, what am I going to say? I'm going to say it's Will, and I live in Bucks County. Make sure you can hear us. So if you can't hear us, type it in the chat. Dima's from Philadelphia. Let us know where you're from. We have, I don't know, almost 50 people on right now.
Okay.
Any questions, put in the question and answer down below. I'm going to pop a little poll question. Question is, do you analyze Greeks when planning your trades? Yes, no. And a third question, what the are you talking about? So take a look at that. Please answer. These are very helpful when we're making decisions about the site. 100% right now say yes, they use the Greeks, and that's 9 people.
Nice.
So it's moving quick. Everyone says they can hear us. We have people from Jakarta, wow, Chicago, LA. So it's 6:02.
I guess we could get started.
Yeah, let's go.
All right, let me just share my screen. Let me do this. And I made some notes today. Let me just add the notes this way. And I'm going to use a different pointer. I'm going to use one of these pointers.
Yeah. Now, anyone on YouTube, listen, put your questions in the chat, and I'll get them to Dmitry at the end of the show. Everyone who's on the Zoom meeting, it fills up fast, our Zoom meeting. That's why we're going on YouTube at the same time. Please put them in the Q&As. All right, Dima, here you go.
All right. And first of all, I want to just say thank you, everybody, for joining us today, Monday evening. Today I'm just going to, it's going to be more of like a educational, and I'm going to go through the option Greeks. And I started getting just recently a lot of questions about like delta and how to do gamma trading. So I just decided to, do a show like on the most frequently asked questions, that I get either through the live chat or through the email. So what we're going to do is we're going to talk about the option Greeks, the delta, the Vega, the gamma, the theta, and the Rho today. And I'm going to go to the next slide over here. And when we talk about option Greeks, the option Greeks themselves, they're coming from an options pricing model. And another question that I do get is, well, how exact are these things? I don't know why everybody, how exact are these? How exact are the deltas? How are they? Remember, the option pricing model is estimating. Nothing's really exact. It's like it's estimating based on statistics, averages, statistics, and assumptions and inputs. So I'm going to explain that a little bit as well to you. But the option pricing model, you guys probably heard of Black-Scholes binomial model. What that does is help us price options so we could compare them to the market. In addition to that, we have option Greeks, and those option Greeks help us manage the risks. And the option pricing models also assume that you know how to use those models and you know how to use those Greeks. So I'll give you an analogy. If you're going to drive a car, the assumption is you know how to drive. You know that if you press the brakes, the car's going to stop. If you press on the gas, it's going to move. If you're low on or empty on gas, you got to get more gas, your tires. So all those things, it assumes you understand it and you know how to use it to make sense of that option pricing model. So so I'm going to get into like, what does delta mean? What is gamma? What is Vega? How do you put them together and use them together to manage your positions? Now, before I go right into the Greeks, I think there are two things important about this option pricing model to understand. Is one, it's assuming that there's a put call parity. I'll explain that. And that when you're trading option pricing models, they're not priced on direction. They're assuming you're trading those option volatility. You're a volatility trader. So I'm going to show you what that means. You're going to be trading delta neutral. That's what the option models are assuming, and that's how they're coming up with the prices. So what is put call parity? When we look at the option, it's going to be assumed that if there's a call, there's also put, there's a corresponding put on the same strike. And what does parity mean? Now, I'm going to explain this really quickly, just so you have a starting point. And let's assume there's no cost of carry. The stock has no dividends and interest rates are completely zero, right? And let's say that here we have a stock that's $100. The stock's exactly $100. If we take a look at the call strike, and let's say the call strike with $100 is equal to $3. That's the premium. And let's assume that the put strike on the 100 strike, on the same strike, the 100 is also $3. Here we have, in this situation, put call parity. It works, right? Because if I buy the call for $3 and at the same time I sell the put for $3, what's my cost? My net cost is zero, right? I paid $3, I collected $3, my net cost is zero. If the stock moves up from 100, I own the call, I just keep making money 1-for-1 with the stock at expiration. If the stock moves down from 100, I lose 1-for-1 with the stock price. So it's a synthetic stock, right? I have a synthetic stock over here with the options, and I could hedge it by selling this stock at $100. So I'm perfectly hedged at zero cost. This assumes that I make no interest on the stock that I sold right now. So what if this didn't hold? What if put call parity didn't hold? Let's take a look at that real quick. So let's assume the same situation. We have a stock at $100, right? But this time the call is $4 and the put is $3. So let's just say I sold the call for $4, bought the put for $3. What happened? I collected $1. I collected $1 and I'm synthetically short the stock at this point, right? Because I'm long the put. I make money when the stock goes down 1-for-1. I'm short the call. I'm losing money as the stock goes up. I'm synthetically short. So I would hedge it by buying the stock 1-for-1. So look, if I collected $1, it's like selling synthetically the stock at $101, right? If I buy the stock for 100 and I hold that position, assuming, remember, no interest, no dividends, if I hold that position to expiration, they converge and I collected that dollar. That's a conversion reversal. So it's important to know that the models are assuming these are always holding true, so that there's no arbitrage opportunities. Conversely, what if it was the other way around? What if the call was $3 and the put was $4, right? Well, what do I do there? Well, if I buy the call for $3 and I sell the put for $4, right? I'm getting long synthetically. Again, buying the call, selling the put, I'm getting long, but I collected $1. Well, since I collected $1, it's the same thing. I'm synthetically buying this stock at 99 bucks, right? Because there's the 100 strike. I'm buying this at $99 synthetically. Well, if I short the stock at 100 and synthetically I'm buying it at 99, I wait for expiration. At expiration, they converge. My stock goes away, depending where the, wherever it's if the stock's above 100, I exercise the calls. If the stock's below 100, I get assigned on the put. They take away my short, and those converge. You keep $1. So put call parity is saying that you're not going to have these arbitrage opportunities. Now, when else would people use them? Let me just go back one more time over here. Let's assume that this is true, right? Exactly true. Well, synthetically, remember, traders are always looking to make money, which means also by saving money. on commissions or carrying costs. So assume I want to buy a stock for $100, but I don't have the money. I need to borrow, right? If I want to leverage and I want to borrow, well, some of it depends, who your broker is, but if they're charging you 6, 7, 8% to borrow, that's a lot of money, right? Like if you're holding it for a year, you borrow, you're holding the stock for a year. In a year, it's like $107, right? If you're paying like 7%. So you could also look to the options to say, well, how much would it cost me synthetically to do, right? So maybe it'll cost you a little bit cheaper. Maybe it'll be like 1% or 0.5%. That's a lot of money that you could save, because the alternative is if you're borrowing, your borrowing cost is much higher. So that's another way that traders will look to use leverage with options. Now, let me just see here. So once we understand that the put call parity, if you guys have questions, just put it in there. I'm going to come back to it right after, after we go through all this. So what is delta, right? According to the model, according to the option pricing model, how do we use delta? Well, delta is telling us the rate of change of this particular option for corresponding $1 move in the stock, right? So we have an option. How much is that option going to change if the stock moves up $1 or down $1? That's what your delta is telling you. So let's use an example, and then I'm going to show you how to use that in trading. Let's say we have a call option with whatever trading days to go. It's $4, and the delta is 20, right? So let's just say the stock is 100. You have a call that's 120. It's a 20 delta. Well, the option pricing model is telling us that it estimates that if the stock falls $1, right, this option, the call option, will decrease by 20 cents. If the stock goes up by $1, it's going to increase by 20 cents. So how does that look? Stock's 100, stock moves down $1. We see that this option is estimated to be $3.80. Remember what I told you. These aren't exact numbers. Option pricing models are estimating. There's a lot of moving parts in there. It's hoping to get you close. But let's just assume right here it goes to $99. This option is expected to go to $3.80. If the stock moves up $1 from 100 to 101, then this option is expected to be $4.20. That's your delta. That's what your delta is telling you. So why is that important in an option pricing model? Like, what do we need that for? So let's go a step further. So bear with me here. The option pricing model is assuming you are trading delta neutral. You see here, delta neutral. You're not speculating if the stock's going up or it's going down. You're trading the volatility. Let's see how that works out. So if the call option is $4, my delta is 20. Let's say the strike is 110 and the stock is 100. If I buy 10 options, if I buy 10 of these options for $4, 4,000 bucks, what is my delta? My delta is 200, right? Because I have 20 delta, right, times 10 options. There's 100, each option has 100 shares deliverable, which is 1,000. So 1,000 times 20 is 200. So what this is telling me right here, this 200 is my position at this point is if the stock moves up $1, my option is going to make $200. If the stock moves down $1, I'm going to lose $200. How do I hedge that? Well, here we go. So I'm long 10 of these options. That means I'm long 200 deltas. To hedge it, I need to short 200 shares. Then I'm delta neutral, right? This is my delta risk. I need to short 200 shares to be delta neutral. So the stock right now is 100 bucks. I sell 200 shares. So let's see how that looks like when the stock moves, right? Let's say the stock moves to $99. We know my options lost 200 bucks, right? Because I have 10 options we bought. They were $4. Now they're $3.80. My options lost 200 bucks. but my hedge made that $200 back. So 200 shares, right, at $100, and now the stock is 99. I was delta neutral, so the $200 I lost on the options, I made back in my hedge in the stock, right? So that's how you're hedging your direction, and then you're going to have to re-hedge it at every point. I'm going to show you how that's done. Let's go the other way around. Let's say the stock moves up to 101. We started at 100. The stock moves up to 101. What happens? My options are expected to gain $200, right? We bought 10 options. We bought it for $4. If they go to 420, like the option pricing model is expecting, those options made $200. My hedge at this point loses $200, right? We shorted 200 shares at 100. The stock went up to 101. We lost $200 there. They both offset. So our P&L on direction offset. That's what that's an example of being delta neutral. That whenever the stock moves, you're offsetting, your deltas are offsetting. So this way you don't make or lose on the delta move. So how do we make money on the volatility? So let's take a look at that. And this is where gamma comes in, right? So what is gamma? We talked about the delta. What is gamma? So gamma is the rate of change of your delta for a $1 move. So remember that when the stock moves, the deltas move, right? If you started out at 20, if the stock is moving higher, closer to that strike, then your deltas are going up. If the stock is moving lower, further away from that strike, then that option delta is moving down. Your deltas are going to be changing as the stock is moving. So your gamma is going to tell you your rate of change in that delta. So let's assume our gamma is 50, right? This is our gamma, 50. What will be our new delta? So if our gamma is 50, and I'm going to show you the example, we started out at 200 deltas. The stock moves down, right? Because we're positive gamma, the stock moves down, we lose 50 deltas, our new delta is 150. If the stock moves up, our new deltas are 250. And that's important to understand because that's how you start scalping your realized volatility, okay? That's how you're starting to trade the stock and the volatility against the implied volatility. Let's look at that example. So let's say our gamma is 50, right? Stock moves from 100 to 99, right? What do? We're going to use that same example. We shorted 200 shares originally. So what does that mean? We shorted 200 shares, we're delta neutral. The stock moved down to 99. Our delta went from 200 to now 150. The new delta on that option is 15 now. Now 20, it's 15. Well, what happens? If our new delta is 150, but we shorted 200 shares, we got to get delta neutral again. That means we need to buy back 50 shares. So out of this 200 shares that we shorted, it goes to 99. We got to buy 50 shares to get back to delta neutral. All right. Once we buy back that 50 shares, now we're going to be short only 150. What happens the other way around? Stock moves from 100 to 101. Well, we originally shorted 200 shares, but we picked up another 50 deltas, right? The stock went up, we picked up another 50 deltas. So it went from 200 to 250. That means we need to short another 50 shares, right? It moved, we got to re-hedge our deltas. So let's see how it looks now from a gamma scalping perspective. Now look, there's a lot of different variations and paths that the stock can travel. I'm just going to show you a simple one so you could kind of picture it in your mind from a simple perspective. So how do we scalp that, right? Let's use that same example I was showing. Our original position, we have 10 call options. We bought for $4, spent $4 grand on the options. We sold stock 200 shares, 100 for $100 at $100 a piece, right? So now what happens? We have gamma is 50, stock drops by $1 from $100 to $99. So what happens here? This call option is $3.80. Our call went from 4 to 380, right? So we lost money on that. We lost 20 cents. But at the same time, we're short 200 shares, right? So we made that $200 back. We lost $200 on the option. We made back $200 on our short. Our P&L for that move is 0. That directional move, both things offset each other, the option and the shares, we're at 0. What do we do here? We rehedge our delta. Remember, our delta went from 200 to 150. We only need 150 shares, not 200. So we buy back 50 shares at 99 bucks, right? We sold these at 200. We're buying back 50 shares at 99 bucks. So what's our new position? Our new position is 10 call options, short 150 shares. That's our new position. Let's say the stock goes back to 100 when it's at $99, it goes back to 100, right? Well, we're back to where we started. Again, we need 200 deltas there, right? We're short 150. That means we got to short another 50 shares to get back to the 200 to be delta neutral, right? So there we sell back that 50 shares. We sell that back out at 100. Do you see what happened? I got back based on this stock movement, right? We got back to our original position, but in between, we bought 50 shares at 99 and we sold it back out at 100. What does that do? We scalped it for $50. Hopefully you guys see that. And Will, let me know if people are putting questions in, if I'm going too fast.
No, it seems good. I mean, we do have a bunch of questions. I was going to let you fire it off and get you at the end.
No problem. So what happened here? We scalped our gamma for 50 bucks, you know, and we went back to our position. Let's say we ended there the day, right? Now, of course, you know, it doesn't have to work out that way, but this is the simplest way I could explain it. So this was a $50 profit on trading the volatility of the stock, right? The more the stock is moving around, the more we're delta rehedging, the more we're scalping, then, you know, the higher the profit should be. So you want volatility back and forth, so you could keep rehedging your deltas. You know, imagine if that was happening like 10 times a day. So let's just say we did that once, it's $50. So that would be, so if nothing else changed, $50 would be our day trading profit. However, let's go to our next Greek, right? So our next Greek is telling us, well, the options in actuality decay, right? And that's our theta. Our theta is telling us how much those options are expected to decay today, every one day. So let's say our theta, our position is 30, right? We're expected to decay 30 bucks. So if nothing changes our original position and implied volatility is the same, nothing changed, the stocks didn't move, we're expected that option will lose $30 in value. So in our example, we profited 50 bucks, right? So let's just see how that works. So in total, we scalped our gamma for $50, but at the end of the day, we're going to lose $30 in decay. So our net day trading, right? Our net P&L for that day would be 20 bucks. So let's see how that looks. Here's an example. End of day, we're expected to lose 10 bucks. So the position at end of day, you know, we started at 4 bucks. We lost 30 bucks on it, right? 10 options, 3 bucks. And we're back to, you know, we're back to the original position. The stock is 100. We're still short 200 shares. So what happened is the original position, the options decayed 30 bucks. We scalped $50. So remember that we bought we bought 50 shares, 99, sold it back out at 100. That's where the $50 is coming from. The decay is coming from the option. So our net day trading profit is $20 that day. All right. That's how you're using your delta, your gamma, and your theta to watch and manage your risk. You see how they're all related? The option pricing model is assuming you understand that and you're using it correctly and appropriately. What is your Vega? So hopefully you guys understand that. If there are questions, I'll go back to that. What is your Vega? Your Vega is, if you sum up all your options, and it's saying that, you know, you own options, sold options, whatever your net Vega is, well, that is how much risk you have if the implied volatility moves up or down one click, right? So if your Vega is 1,000, if you have 1,000 Vega, if your options, if you have a positive 1,000 Vega, options increase by 1 implied volatility, that position, the premium is expected to rise and your profit would be $1,000. That's your exposure. If implied volatility moves down by 1, then you're expected to lose $1,000 with 1,000 Vega. That's a positive 1,000 Vega. That's what your risk is, right? So you want to watch that as well, because if you have a lot of Vega risk and implied volatilities are moving and could move against you, you want to watch that risk. And I'll go to the options chain and kind of show you the Vega risk as you go out in time. The last one I wanted to talk about, I think I put it in here, is your Rho risk, your Rho. So what is Rho is, that's the one where, remember, you have a cost of carry as well. So if you're buying up, like say you're buying calls, you're shorting stock, that's money that's brought into your account. You're selling calls, you're buying stock, well, you have to, that's money that you're not getting in the bank or you have to borrow, right? So there's a carry, there's a carry risk going on depending on what you're doing. So let's just assume you have a bunch of calls and you shorted stock, right? You shorted stock, and that money that you shorted, you shorted 1,000 shares at $100, right? You're delta neutral. That's $100,000 in the bank that every night could be earning interest depending on where the interest rates are. Well, if the interest rates go up, that's good for you because you're earning interest. So if the interest rates move from 2% to 3%, you got that in the bank, just sitting there as collateral, you're earning interest. That will be good for you because then you're going to be earning more interest. If the interest rates go down and you're short stock, you got the money in the bank from where you shorter at your brokerage firm, interest rates go down. That means every day now you're earning less interest. So that's what your Rho risk is. Looks at your position and tells you, here's your exposure to a 1% interest rate move. So if it's $1,000, if it's 1,000 interest rates, move up 1%, that means you could potentially, those options will reprice for those interest rates and your position should make 1,000. Or if it goes down, those options will reprice because that, interest rates are already priced into the options. They'll go the other way and you'll make $1,000. So that's your Rho risk. I kind of went really quickly through it because I was imagining that there's going to be lots of questions around it. So I'm just if you're ready, I think I could just go to the questions.
All right, we'll go. First of all, before we get started with the questions, do you want to talk about we have a couple questions about second order Greeks. Do you want to go into that today or stay away from that?
Well, I would stay away from that because I think just on this alone might be, I don't know.
It could get confusing.
Understand this, but there's Greeks of Greeks, right? So I think what they're explaining is, what is the gamma of the gamma or the rate of change of the Vega and so forth. But let's just stick to the, to the initial Greeks.
All right.
for
Well,
now.
John Smith is asking, can you show examples on an options chain for put call parity? Kind of walk someone through on the Chameleon how they look at put call parity in an options chain.
Sure. All right. So let me exit from here. So let's just say, you know, we could use SPY, right, as a example here. So any strike you look at, right? See here, any strikes that we look at, they're going to have a call and a corresponding put. So that's the put call parity. It's going to look at the same line, the call and the put, call and put. So here, let's just take a look here. Let's say the 311, right? We bought the call, sold the put. Bought call, or you do the reverse, right? Let me just show you what this is. See here, this is a synthetic stock, right? This is what it'll look like, just like a stock. So I'm long here. If I short 100 shares, right? This is it, right? This is the P&L. You lose $1 because if you're doing it right on the market, 23 cents. You want to do it at 27. So what do we have here? This is the 311 call, right? The stock is 1076.
Hey, D,
Right?
hold on one sec. For some reason, try sharing again. We're not seeing the screen.
Oh, really?
Yeah.
Okay. Tell me if you see the screen.
Yep, there it is. It's back.
Yep. Everybody sees it? You guys are okay?
Yep.
All right. So I'm just going to pick any string. So here's an options chain for SPY, right? This is SPY options chain. I'm picking the July 10th, right? So there's 13 trading days to go. So as you can see here, there's no dividend. Let's say assume zero, interest rates are almost zero. And I'm just going to look at this. Every strike, you see every strike has a call and a corresponding put. That's when we look at put call parity. Call, corresponding put. So let's just take one over here, the 311. I'm just going to take like near that the money. The 311. Let's assume I'm going to create a synthetic long. I'm going to buy that call. Okay. So I'm buying that call, 721. I go to the put and I sell the put, 744. Let's load that strategy. So when you load this strategy, you see what it looks like? It looks like a synthetic stock. If the stock increases from 111, you just make money $1 for dollar. If it decreases from 111, you just keep losing dollar for dollar. It's a synthetic stock. This is a long synthetic stock. How do you hedge it? You sell short 100, right? Because I only did one option here. Bought one call, sold one put, sell short 100. And this is what it looks like. It's flat no matter where you go. The difference is you lost $1 because of the prices, right? Because here, so let's take a look here. The stock is 1076, right? 1076. If I did it bid to offer, I bought 721, sold 744. That means I only get a 23 cents credit. 23 cents credit from 311, which is saying that we bought it for like 310.77, right? 310.77. We sold it for 310.76. We shorted 310.76. We lost $1. So you would want to do it like 24 cents, somewhere in the midpoint. But that's what it looks like, right? So if you did it exactly, if this was at 24 cents, you got 24 cents. That's like buying the stock 310.76 and you sold it for 310.76. Same thing everywhere you go. Let's just do another strike. Let's do the 307 strike, right? Bought the call, right? Sold the put. Same strike, right? This is conversion reversal. You bought the call, 978, sold the put, 601. This is what it looks like. Again, it's a synthetic long. Put call parity. What do? We sell short 100 shares there you go. You lose $1 here just because of the prices, how they're lined up. If you're doing it, you know, exactly on the bidders and offers. But see here, you're completely hedged, no matter where it goes. Let's go 20% around. That's how put call. So put call parity is saying that this, you know, you shouldn't profit, or if the options are efficiently priced, then you shouldn't be able to arbitrage it, and it should always be like, you know, at the 0 line. Does that make sense? Did I answer that question?
I thought so. That was great.
Yeah.
Next question, stay on the chameleon.
Okay.
Someone's asking, where can I see the Greeks? How can I see the Greeks?
Okay. So let me just close this. So here we have the Greeks here on the sides, gamma, vega, theta, rho for each option. So it's always defaulted to the deltas. So these are your deltas, right? So here, 315 call, 41 delta. So if I bought 10 of these, I'll be long 410 deltas. Let's see that. I'm buying 10 of these, right? 10 of these, 410 delta positive. So here's your delta, 41.3. Sorry, 10 of these. 413 delta. So it's just rounded a little bit. That's how you would do it. Now remember, this is a positive delta. If you did on the option, on the put option, puts have a negative delta, right? So I would have to go the other way. What if I bought a put? Well, to hedge it, I'm short, I'd have to buy stock. So this is 43 delta. Let's just take a look at that. Let's change this to 10 options, right? So now I'm going to be short 10 options times, which one did I do? 308, this one. So see, now I'm short 430 deltas. Long 10 puts, I need to buy 400 shares. This is what it would look like. You know, 430 shares. See this is my delta now. And that is delta neutral. It's going to look like a straddle because it doesn't matter which way it goes. Does that help?
Yeah, no, that helps a lot.
Any other? Well,
yep, I got a question here. It's a particular stock. You want to take this question? NKLA.
Okay.
The question starts off, does put call parity happen often? And then he goes, in NKLA today had a gigantic skew to the put side, for example.
Right.
What does that mean when put call parity doesn't exist, or you have a skew with such a steep skew?
Right. So this is the, oops, sorry. I'm trying to minimize something on my screen. So what's the symbol? NKLA, right?
NKLA.
Okay, so put call parity, remember that this is what the option pricing model assumes, okay? No, it doesn't always have to hold that way. We're working on assumptions. So the option pricing model assumes that you could borrow any stock in as much as you want, right? It doesn't, that's the assumption of the pricing model. But in reality, we know you can't just go to your broker and locate any stock you want, especially stock, you know, low float stocks. You're not going to be able to short every single stock. Well, what happens if you can't short it? If you can't short it, you can't create an arbitrage. Or you may be able to short it, but the lending rate is really, really high. So for example, I could go maybe this NKLA, the brokerage firm may lend it to me, but they're going to charge me a huge fee. So if they're charging a huge fee, the options start reflecting that fee. Otherwise, you'll have an arbitrage opportunity, right? You're like, well, you know, I don't have to pay you the fee. I could just go in the options market and, you know, create it for free. So what the model assumes is not always what happens in reality. So in this situation here, I'm looking at these options, right? 4 trading days to go. It's probably impossible to short it. In my opinion, like I'm just looking at these markets, it's impossible to probably short it. So
Can you explain that real quick? When you're saying it's impossible to short.
So impossible to short is like you could go, before you short a stock, by regulation, you have to locate it and borrow it, right? You can't just short a stock. Somebody has to lend it to you and say, well, here's my stock. I'm going to let you borrow it. And basically what you're doing is taking somebody's stock and selling it, right? With the promise of giving that stock back. But you have to find somebody to borrow it from. You can't just create a phantom short. You can't just say, okay, I'm just shorting stock.
And that borrowing rate is the row, correct?
Well, no, it's not. So no, it's not the row. So the option pricing model doesn't even have a component for hard to borrow. They assume it's not going to even happen, right? Gotcha. So it's almost like a dividend yield. You would have to tweak it, the model. It's not a perfect model, and that's what I'm saying is things are not exact. So in this situation, let's just take a look at this, like what's going on here. And I'm going to show you why the put call parity doesn't exist. So remember, if put call parity existed, this 70, I should be able to buy this call and sell this put, and it's the same thing as buying this at $70 minus whatever interest, right? But if I can't hedge it, right, because that's assuming I could hedge it. If I can't hedge it or I can't borrow it, I can't create that arbitrage. And that's when these start moving away. So look at this. Look at this. If I buy this at 360, right? If I buy this at 360, the 70 call, and I sell this put at the 70 put at $8, I'm just doing it right there. 360, $8. Look what happens. This is like buying the stock, I'm getting $4.40 credit. Here's the stock price right now, $69.90. It's like buying the stock down here, 65 cents, because you're getting an extra $4.40. You're getting at this huge, if you want to get long this stock, right? If you want to get long this stock, synthetically, by doing this option, you're getting 65, like 65.60, right? It's like 65.60 because they're giving you $4.40 because the people who want to short are already willing to give that much money to you so they could be synthetically short. They're saying, I don't care, this stock is 70, I'll short it assuming it's 65.60, that's the fee they're willing to give to you to short this stock. That's hard to borrow. I don't know if you guys deal with your brokers, and I don't bring it, most people I think do not short these. I mean, especially with these hard to locate, you're not, even for market makers, it's the same deal. See, these are market maker quotes. They can't locate the stock either because you have to have somebody willing to lend you that stock. So this is where put call parity, doesn't hold because you can't hedge it, right? Look what happens if I was able to hedge it. Let's say I was able to hedge this stock. Let's say there was no fee and I was able to hedge this stock. Look what would happen. Look how much you could profit. $430, riskless $430, no matter where the stock goes at expiration, right? Here, 20%. Let's make this 20% around. Doesn't matter where it goes. That would be a riskless $430. The problem is you cannot fully hedge this. You can't borrow it. That's the problem.
Well, it's why the skew's there, right? The professionals can't borrow the stock either. No one can short this stock.
Exactly. Nobody can short this stock. So the skew just keeps going up and up until they could find somebody willing to either lend them the stock or somebody just willing to take that risk, right? So somebody at some point might just be willing to take the other side of this bet because, if you could, if you could get this stock, maybe, maybe this is enough, who knows, 65.50, there could be downside risk or upside. I don't know where this stock is going, but maybe that's enough cushion for somebody to take the other side of that. So I don't know what this stock even does, but I'm just analyzing it from this perspective. See, here's the stock, and here's synthetically where it's being priced this far below. Hopefully that answers this question or helps out.
Yeah, I think that will help. Saeed is asking, can you talk about implied volatility, and is that Vega, he asks?
So the implied volatility is not Vega, but the Vega tells you, right? So let's just go to the Vega. So this Vega is telling you how much this option will change if the implied volatility moves by 1, right? So if this implied volatility increases by 1 to 167, then this option is expected to go up by 2 cents. That's this. If this goes down to 164.80, then this option is expected to lose 2 cents, 88 cents. That's what the Vega is telling you. It's telling you how much your option price will change for an implied volatility move.
Awesome.
These are your implied volatilities. These are your Vegas.
Do you want to walk through the Greeks of a bull call spread? Mark is asking actually how you look at them, how you find them. Maybe you showed that really quick, and he's asking about it again.
Okay. Let me move back to maybe like SPR or something that's not so.
No, that's fine.
And what did he say? Bull call spread?
Yeah, he's asking, can you elaborate on the bull call spread Greeks?
Okay.
He goes into it. He says, with the gamma, if in the right direction, it is like increase the delta and buy in by the stock automatically. He just wants you to walk through, I guess, your example one more time.
Okay. Sure. So here's the thing with when you're doing multiple options, right? When you're doing multiple options, their Greeks start to, they could offset or increase each other, okay? And they become dynamic. Basically, it is possible to go from a long gamma to a short gamma, depending where your long and short options. So I think it would be very hard to show that. Let me think if I could. I don't know if I can display that example, but look. But here's an example of a call spread, right? So here we're buying, let's say 313 call. So when we're doing a vertical spread, we're going to be buying one option, we're going to be selling another option. So what are the Greeks right now for just buying this option? So we know that we're long delta, we're long gamma, we're long Vega, we're short theta. These all make sense because when you own an option, you're going to be long gamma, long Vega, and short theta. It's going to decay. When you sell an option against it, you're going to offset some of those risks. Your deltas should go down because this is long delta, but this is short delta. Your gamma is going to go down because this is long gamma, this is short gamma. Your Vega is going to go down, and your theta is going to go down. So let's just look at that. So you see, they all went down. Now you're 0 gamma, 0 Vega, or close to 0 and very low delta, 4.4. So it's almost like you already offset it through options. But remember that these are assuming you're always rehedging, and as you're getting further away from one option and closer to the other option, right? Then the closer you are, whatever option you're closer to, that's where more of your risk is coming towards. So you're moving along from your long to your short. So if you're always rehedging, that's where it gets tricky because these are all dynamic. All these, they're dynamic. They don't stay the same. They're going to change throughout the day. The implied volatility is going to change them, and where the stock goes is going to change them. The time of day, they're going to decay. It's going to change them. So it's very dynamic. And we talked about this in the beginning. There's nothing exact here. You're managing. So think of it as you're hedging off. You're reducing your risk, right? You're not perfectly hedged. There's no such thing as perfectly hedged. Well, maybe the conversion reversal, if I was showing you if it's easy to bar, but you're never perfectly hedged. You're always offsetting those risks. Okay. So that's kind of like the idea here. There's no, nothing here is exact, but it's approximation. It's getting you very close, or it should get you very close.
You up for walking through a credit call spread in a particular stock and looking at it? Is that something that
What's the
interests you?
question with the credit call spread?
Pradeep is asking a credit call spread, short the 50 delta call, long the 25 delta call, 2 days before earnings for GME. He wanted to see it on the Chameleon. And he's like, how do I interpret this? How do I look at, how do I look at the option table? And,
He's saying for GME?
Yeah, GME. I think that's GameStop.
Okay. So, I mean, I don't know. Is it supposed to come up with earnings soon?
I don't know. Do we have an earnings there? It doesn't look like
maybe. I'm not picking one up. So, I mean, it's possible. Like, this stock is very, it's a low price stock, right? So as the lower price you get, these become a little bit, harder because, but let's just take a look. What was his question again? 50, short the 50 delta?
Yeah, short the 50 delta call, long the 25 delta call.
Okay, so remember, you're never gonna find exactly a 50 delta call all the time or 25 delta call. So you have to kind of look at what is the closest. So here, I'm seeing here's a 52 delta call. Well, hold on a second. So here's I just jumped back to July 17th. So here's a 51 delta call, right? That would be this strike. This called the 5. The 25 delta call is over here. So you would buy this at 19. So that's how this strategy would look like, a bear, right? So because you're selling the 50 delta, buying the 25, it's a bear call spread. You would make this 20-cent credit, or remember that one thing, and I do mention, you got to be careful of this bid-ask spread, right? So see it's 20 cents, 30 cents, midpoint's 26. You always want to try to get as close to the midpoint as possible, 26, 25, 27, because the further you go away, that eats into your profits. That's like your fee. So be careful of this.
While you're on that bid ask difference, Jeff asked earlier, does that bid ask difference actually affect how you look at Greeks?
So it wouldn't affect how it would. It looks. I use it for the execution, right? That's kind of like your fee. Your expectation of you always want to get a better price, right? You always want to be able. Why sell at 20 cents if I could get 21, 22, 23? But you use that midpoint. That midpoint is kind of the industry standard of the fair market value. That's like your fair market value, because that's where, if somebody's willing to pay $1 or somebody's willing to sell it, let's say at $1.10, well, somewhere in between is fair value, right? That where nobody's trading, that in between is considered like a fair market value, like 105. And that's where your options will get marked. So your option, if the option is $1 to $1.10, if you sell it at $1, it's going to show up like you lost 5 cents immediately in your brokerage account. You bought it for $1.10. Remember, they think it's worth $1.05. So immediately it's going to show up as you lost 5 cents. You always want to try to get it, as close to the midpoint if you can as possible, unless you're very sure of yourself. Like if you think like, whoa, like this 20 cents is like way overpriced, this should be worth 0. And then of course you could always just hit that bid, but it does make a difference, your execution costs, because these are options. Like think about it. You have an option, $1, $1.10, right? If you lose 5 cents on it, that's 5%. It's a 5% of your potential profits. It adds up. Imagine every time you're paying 5-10% fees every time you do an execution.
Yeah, you got to be really careful when you get into any equity option, and you got to take a look at all the spreads, because if the wider they are, it's going to cost you to get in and out a lot.
Exactly. Exactly. So you want to be careful with that, with the bid-ask spread.
You want to see the poll real quick? The results?
Sure. Should I stop sharing my screen or okay?
Yeah, you can stop sharing. We're
Okay.
we're butting up against the hour. Most of the questions have been answered. There's the poll.
Okay.
64% of the people responded today. That's about 40 people said they do use the Greeks when planning their
Awesome.
trades.
Awesome. That's great. Well, hopefully this was helpful. I wanted to kind of address most of the questions that I usually get, you know, kind of like as an introduction. So hopefully this was helpful to everyone.
I think it was. I think it was. Now, if you're on YouTube, and even if you're not on YouTube, and if you're in Zoom, go to our YouTube channel and pre-subscribe. It's super helpful, and you get instant notifications when we go live. We had a good turnout on YouTube today. You know, well over 50 people the whole time, which was great.
Awesome.
Next week, Dmitry, we're going to have a big silver trader. Chris Marcus from Acadia Economics is going to join us, which is going to be outstanding.
Awesome. Yeah, he has great insights.
Yeah, very interesting trader. He uses the Chameleon to do his research. So he'll be with us next week talking silver. So if you have any questions you want Chris to think about all week, just email me and ask for Will at support@MarketChameleon, or any other questions, ask for Will, and we'll get to you. Anything else, Dima?
No, I think that's it. Unless you have one last question from anybody, I could.
One last question. All right. We do had some questions pop up.
Okay.
Someone's asking, they're asking the name of next week's guest again. It's Chris Marcus from Acadia Economics. Someone's asking, can we get a time series of Greeks? Does that even mean anything to you?
No, I don't know what that is. I'm not sure what that is.
All right. Someone else asks, you mentioned Vega for all positions. How do you calculate Vega?
So the Vega is just basically, it's going to be cumulative, right? So if you have, let's say this here, let me just get off this stock. Let me just go back to SPY. I think it's just easier. You know, so look, so these are cumulative. So let's just say, you know, I bought 10 of these, all right? So what is my Vega position? Well, my Vega position right now is 206, right? But if I buy another option over here, let's say buy another option, oops, right? And I buy 10 of these, my Vega is going to go up because I'm buying it, right? So now my Vega is going to go up because now I own two options. So I just increased my Vega. But let's say I sold Vega, like I'll sell one of these, right? Let's say I sold 20 of them. So my Vega now should go down from 410 over here to 35 because now I sold the Vegas. So it's just cumulative because it's assuming that the implied volatility, you know, will move by one click in all of these simultaneously. So what this is saying is that if this moves down one vol, this moves down one vol, and this one moves down one vol, that this is your risk, 35. So I'm still long 35. If they all move up one, you make 35 bucks. If they all move down one, you lose 35 bucks in this position.
Wow, that's helping out right to the end, Dima.
All right.
Listen, I just put the link to Acadia Economics and Chris Marcus's website in the chat on both YouTube and on our Zoom meeting, so we'll let that sit for a second. It's a great show, D. Thanks for leading us down the pathway of Greeks. A lot of interesting information.
All right. Thanks, everyone.
Thanks for joining us. Have a great week. As always, give the Chameleon a try. Any questions, support@MarketChameleon. We make a real effort always to get back to anyone who emails us. Have a great night, Dima, and all the chameleons out there.
Thanks, everyone. Have a good night.
Bye.